morning from the Protos newsroom. The date today is Wednesday the 25th of November and you're listening to the Protos Daily. The main headlines this morning: OKEx to give free money to returning crypto traders. Major Japanese bank SBI opens Bitcoin borrowing scheme with 1% returns, and a retro altcoin Ripple has pumped more than 270% in the past week. At the present time, Bitcoin is trading over $19,000, up 6.5% for the past week, and only a few $100s away from an all-new time high. Crypto exchange OKEx is offering users up to $1,000 to return, following a recent raid that saw company founder Ming-Xin Zhu detained for more than a week. The exchange says it will offer the funds to users who held more than $10,000 when withdrawals were suspended last month, and the incentive would be scaled to their trading volume at the time. Indeed, it's been weeks since OKEx users have been able to withdraw their crypto. Zhu personally held the private keys for the exchange's crypto vaults at the time of his cooperation with police, rendering the exchange unable to process withdrawals. However, trade on OKEx has continued, with nearly $7.7 billion in crypto exchanged in the past 24 hours. Exact details about the case are scarce, with some interpreting it as a sign that money laundering probes might be underway across the China region, but Chinese authorities have made no official statement, and no charges have been filed. For what it's worth, Zhu told his WeChat followers the matter relates specifically to an equity merger of his blockchain R&D company, OK Group, and that he's cooperating with the investigation. OKEx says withdrawals are set to resume either, quote, on or before this Friday. Japanese financial giant SBI has outlined a new cryptocurrency borrowing program that offers 1% annual interest on Bitcoin deposits. As part of the offer, the Tokyo-based financial firm says it will not bill customers for management or account fees. However, it will charge them for yen withdrawals. SBI set a minimum period of 84 days, which might be relatively short in the old-school finance world, but is the equivalent of eons in the crypto space. For instance, Bitcoin traded at just under $11,000 84 days ago and has now risen over 70% since. SBI also pegged the minimum amount for borrowing as 0.1 Bitcoin and the maximum as 5 Bitcoin, representing between $1,900 to $96,000. Although this may sound lucrative to some of our listeners, especially in the face of monumentally low interest rates, we feel obliged to highlight one of Bitcoin's core tenets: not your keys, not your crypto. Now for a story that very well could have been ripped directly from 2017. Notorious altcoin Ripple has pumped 270% in the past week to reach a 2-year high, with its most recent rally sending popular crypto exchange Coinbase briefly offline. Disgruntled users took to Twitter to lodge their formal complaints, with some traders locked out of taking profits they've been waiting for since early 2018. Ripple peaked as high as 90 cents on certain exchanges yesterday, representing a 30% jump in less than 1 day. But while it's a decent rally, Ripple is still more than 80% below its $3.60 all-time high. Coinbase has since come back online and is currently experiencing relatively fewer problems. Topical DeFi platforms Yearn and Pickle will merge following a devastating hack that saw $20 million in customer funds drained from an unsecure smart contract. As a result, the entire Pickle system will be integrated into Yearn's, and the metric for their total value locked in their platforms will combine. A new token called Cornicon will be created to help navigate the complicated mess that is DeFi, and will work similarly to IOUs for those who lost money due to Pickle's smart contract snafu. Yearn's founder Andre Cronje promised this will lead to more, quote, synergies and higher rewards for users. The price of the Pickle's native token jumped 36% on news of the merger to clear $17, 40% below its price just before the attack, and still 80% below its all-time high set in September. In a move reminiscent of a particularly conservative James Bond movie, President Trump's spy chief has raised concerns that the Chinese Communist Party's influence over digital currencies could see the US left behind in the global digital currency race. In a letter to the Security Exchange Commission chairman, Jay Clayton, earlier this month, Director of National Intelligence John Ratcliffe pointed to the fact that more than half of the world's cryptocurrency mining operations are located in China, and that China's mooted state-controlled digital currency would make it tough for US-based companies to keep up. The letter follows an executive order from Trump, prohibiting transactions between anyone in the US and a host of companies linked to the Chinese People's Liberation Army, warning that the PRC exploits United States investors to finance the development and modernization of its military. It's possible that the executive order could apply to Chinese-linked digital currency companies. Now that's a new take on the classic China-themed Bitcoin FUD. Coinbase Pro is halting all margin trading on the platform as of today, ahead of plans to take the product completely offline next month. The exchange cites new guidelines from the US Commodity Futures Trading Commission that technically makes it impossible for it to offer crypto margin trading to users and remain inside the law. The move comes amid an apparent global crypto crackdown, which has seen founders of Coinbase competitor BitMEX arrested and charged with operating unregistered derivative markets and breaking US money laundering laws. BitMEX long allowed users to trade crypto on margin in much the same way as Coinbase Pro, however with just 3 times the leverage instead of the surprisingly high industry standard of 100. For what it's worth, Coinbase is framing this as a failure of traditional finance to allow for new technological innovations, rather than a compliance issue on its part. It's also not the first time the company has pulled the plug on margin traders, having relaunched the service in February this year after offering it briefly back in 2017. Some analysts have speculated that the loss of the overall capital actively trading Bitcoin could negatively affect its price. Long-term Ethereum holders appear to be licking their lips at the prospect of some juicy staking rewards, with more than 15 million addresses joining the network in the past year. As excitement grows around Ethereum 2.0, data from Into the Block shows that the number of addresses holding Ethereum for over a year has risen by 67% in the last 12 months. This takes the total number of addresses with a balance on the network to 49 million, according to Into the Block. Keep in mind that it doesn't translate to 49 million individuals, as anyone is free to create as many addresses as they like. Earlier this week, Ethereum's 2.0 smart contract finally hit the 524,000 Ether minimum needed to fire the starter pistol on Ethereum's most ambitious upgrade to date, the 2.0 Beacon chain. The rebooted network central nervous system will introduce a raft of new features, including proof of stake and the long-touted, almost mythical, blockchain sharding. Ethereum is now moving away from proof of work into a new proof of stake era, which requires participants to hold 32 Ether, now $19,000, or 1 Bitcoin if they want to participate in the network and collect rewards. Whether it all works and whether it's all economically viable is still up for debate, with the transition expected to take roughly 2 years. Thank you for listening. To stay up to date with the latest from the world of crypto, make sure you subscribe to the Protoss Daily on Spotify, Apple Podcasts, and all other major podcast providers,